right, good afternoon, everybody. Uneducated Economist here. So in this video, we are going to be talking about the problems that many of the countries and nations and corporations and people are going to face around the world when it comes to dollar funding stresses. And this is not something that is well known or even talked about when it comes to understanding the economy, not only from a local level like here within our own sovereign nation, but then also the global economy and how it is that the globe uses the dollar and how the dollar is actually going to create problems as people try to get out of this dollar. Now, let me just refer back to dollar funding stresses in China. Now, this is a document that came out from the Federal Reserve. I think it was in 2022, if I remember right. Let me see. It was November 1st of 2022. It's funny how so much Fed documents come out in November. It's really weird. Anyway, this goes on to say this. This is in part 3 of this document, the spillovers from China. Now, I think this is really very interesting because, again, it's not like a lot of people discuss this or even understand what it is that's taking place. So let me just kind of read through this document and then we'll talk about it a little bit. It says here, dollar funding stresses in China could spill over to the rest of the world through several channels. A lack of funding in U.S. dollars for Chinese non-financial corporates and financial intermediaries could result in difficulties in the ability of these firms to roll over dollar-denominated debt, potentially causing them to default to their lenders, which include U.S. banks and banks to which U.S. banks have exposure. In turn, defaults or distress of Chinese non-financial corporates or financial sector firms could lead to concerns that other similar positioned institutions, both in China and other countries with dollar exposure, would also default. Now, I know for a lot of people that might be really confusing and they're like, that's China, who cares, let them suffer anyway. I don't think people quite understand the contagion that can take place from this. See, everybody's leveraged off of everybody else. And if one person starts to default, well, when somebody is defaulting on a loan, that loan is another person's asset. Like, they bought that loan or lent that money out there, they need to get paid themselves. Now, the problem that really starts to face is how this leveraged contagion really starts to take place from a remote location, like even in China. Here, it gives an example of it. It goes like this. In a recent example is contagion risk from debt troubles in China Evergrande. Remember the developer Evergrande out of China, like one of the biggest property developers in the entire world? A large Chinese real estate developer. Such financial disruptions can and have caused dollar-denominated corporate credit spreads to widen, affecting other asset classes, including those of U.S.-based U.S.-based yield debt. For instance, the rising default risk of Evergrande induced significant widenings of bond spreads in connected countries in Asia and in the U.S. high-yield bond market. Very interesting to think about. Evergrande, Chinese corporations, starts to fail, and this is affecting the yield in U.S. businesses. Okay? Asia and U.S. high-yield bond market. Aside from detrimental effects on the cost of debt financing, dollar funding stresses in China could induce fire sales of dollar-denominated assets such as U.S. treasuries and a contraction in the quantity of credit in some countries in which China's banks are active lenders. Now, I know there's a lot here, but just take this into consideration. Could induce sales of dollar-denominated assets such as U.S. treasuries. What would cause this? Right? The effects of debt defaulting. Like, if you are a corporation that is on the verge of default, like you're this Evergrande corporation, and you need to come up with dollars fast, what is the easiest way to come up with dollars? Well, selling off your dollar-denominated assets, such as U.S. treasuries. So when you see U.S. treasuries on this fire sale, think about what it is that those people are looking for. They're looking for the dollars to pay back their dollar-denominated debt. That's what's really taking place. They're not trying to get out of the U.S. Treasuries because they hate the dollar. They're trying to get out of the U.S. Treasuries to acquire dollars to pay their dollar-denominated debts. That's what's occurring. It goes on to say, let me read it again, just so it kind of clarifies. Aside from detrimental effects on the cost of debt financing, dollar funding stresses in China could induce fire sales of dollar-denominated assets such as U.S. Treasuries and a contraction in the quantity of credit in some countries in which Chinese banks are active lenders, meaning they can no longer actively lend that money out there to those nations because they're in a position in which they're trying to keep the dollars. And in fact, they're trying to acquire more dollars, not lend them out there. They're taking their money that they had lent out and getting it back by selling those U.S. Treasuries. They just simply can't do it anymore. These financial stresses could trigger or exasperate a regional or global recession. Among other knock-on impacts to the economies of the many connected countries, surges in sales of U.S. Treasuries can also cause dysfunctionality in the secondary markets for Treasuries, as occurred in March through April of 2020, after the World Health Organization declared COVID as the global pandemic. Very different from where you hear a lot of other people out there who are very concerned about the globe giving up on the dollar and using the U.S. Treasury sales as evidence of it. When you look at it from a macroeconomics level, from a bigger picture, you can see that the U.S. Treasury sales are more about trying to acquire the dollars to pay the dollar-denominated debt that exists out there. It's quite extensive. China's direct financial linkages with the rest of the world have increased in recent years. You know, you think about like the Belt and Road Initiative, where they're out there lending money to these other nations out there so that they can build up their infrastructure. That's almost exclusively done in US dollars. Did you know that? Like, those countries owe China in dollars. And if there's dollar funding stresses, those countries are going to be in stress to China in order to get the dollars that they need to get back to China to pay off those debts. China's direct financial linkages with the rest of the world have increased in recent years, even though they are more limited than what would have been implied by the size of its economy, in large part due to its gradual approach to loosening of capital controls. Among the advanced economies, Japan and the European Union have the greatest financial exposures to China. Direct linkages between China and the United States have been growing, as U.S. mutual funds exposure to China have increased through both equity and debt. With such increased investors' exposure to Chinese financial markets, investors in global bond and equity mutual funds could experience a relative rapid decline in their wealth after a fall in Chinese debt and equity prices. Another link in the opposite direction in significant amounts of U.S. Treasuries held in Chinese foreign exchange reserves. So again, you think about how it is that all these companies, all these people, all these entities, all these sovereign nations are all leveraged against each other. And most of the time when you find it, it's done in dollars. And this is where the dollar funding stresses can really start to create problems for all these nations around the world, which have a contagion effect that can affect people that didn't even have anything to do with them. Right? Despite the nascent direct linkages, the transmission of financial shocks to the date has been experienced through changes in the market sentiment and repricing of risk. For instance, in August of 2015 and January of 2016, rapid declines in Chinese stock market of 26.7% and 18% were felt in the United States, with declines in the S&P 500 over the same period of 7.7% and 8.8% respectively. Recent estimates by the OECD Research Payne and Restucili, I don't know, these two researchers, suggest that a slowdown in Chinese induced by stress in the property development sector would affect global equity markets. partly over uncertainty surrounding financial conditions, causing a repricing of risk. The OECD Global Economic Model suggests that that the largest financial impact would fall on Japan. Wow, did we not, like, think about it. This came out in 2002. Did that not take place? I mean, it's not like they didn't know. It's not like the Federal Reserve didn't even put a warning out about it. Like, I go back and I read this and I'm thinking, damn, why didn't I remember that? For when the issues started coming up in China, to understand that the Federal Reserve was well aware that that would happen. Here it is, they're describing that there was going to be issues, right? Perhaps surprisingly, their model suggests that the financial impact in the United States would be higher than the trade and supply shock components. Generalized contagion through global financial markets could also impact countries that maintain hubs for financial markets of all types. For instance, London, New York, Singapore, Hong Kong Special Administrative Regions, the SAR, account for 75% of all the OTC foreign exchange transactions in 2019. You know, all these times I hear people talk about how it is that the dollar is going to get abandoned. Nobody wants it. They're like, you know, it's obvious. It's only a matter of time. Just, you know, count your days and it's all going to be over. None of those people have taken this into consideration. They just assume that it's just on its way out. They read a couple of articles and then take that in consideration because they hate the Federal Reserve themselves. They just assume that everybody else in the entire globe hates them as well. But very few take into consideration that most people have written debts that are due in dollars, taken out debts that are due in dollars. They have to work, they have to acquire, they have to sell something to get those dollars in order to pay that dollar-denominated debt back. Potential solutions to the lack of US dollar funding for China. Think about it. This is 2002. Like, they're trying to come up with a way that they can figure out how to get those dollars to China. Right? Does this sound like anything like the administration would be talking about? Absolutely not. Right? Most people look at this and they're like, man, this is so backwards from the way that I understand the economy, is because the mainstream media has deliberately messed your mind up when it comes to understanding this. They literally do not give you good information. They direct you in a misguided, very disingenuous way of looking at the economy, and that's literally to scare you, to keep you in line so that your fear is their control. All right. Potential solutions to the lack of U.S. dollars and lack of U.S. dollar funding for China. Here we go. While there are many motivations for issuing dollar-denominated debt, as noted in Section 2 of this document, excessive buildups of dollar funding to Chinese corporations and financial institutions are concerning whenever stressful conditions ensue. Recognizing its institutions' large and growing exposure to U.S. dollars, Chinese authorities have taken mitigating measures, but their effectiveness remains unclear, especially in the near term. There are several existing avenues through which China could obtain U.S. dollar funding on short notice. However, the reliability of these avenues is uncertain. So you think about this. This is them planning, trying to figure out how it is that they are going to get the dollars to China so that this contagion doesn't rip across the entire globe. How many people think about it this way? Zero. Nobody. Everybody thinks that China is trying to abandon the dollar because the BRICS nations are trying to kick the dollar or the United States out of global trade. That's not even the case. That's not even close. Chinese banks are generally required to maintain mostly balanced positions of foreign currency denominated assets and liabilities, including off-balance sheet derivative positions. However, even if overall exposures are close to zero, maturity mismatches whereby short-term dollar liabilities need to be rolled over are problematic. The new Basel III requirements, specifically the net stable funding ratio, attempt to limit excessively risky maturity mismatches in each currency. Although China has officially implemented this standard to counter excessive mismatch risk, maturity mismatches are an integral part of the typical bank's business model. Aside from regulations amid the domestic banks, Chinese authorities are increasingly restricting debt issuance by non-financial corporations in the property sector and by LGFVs, which is government finance vehicles, something like that. Lowering overall debt issuance of non-financial corporations and LGFVs could reduce dollar exposure, but only if dollar-denominated debt is reduced proportionately. You see what they're doing here? They're trying to hey guys, you have got way too much dollar-denominated debt. You got to deal with this issue because it's going to cause dollar funding stresses, and when that happens, the contagion is going to rip across the world. How do we get you out of this dollar-denominated debt? The Federal Reserve is literally saying this about China. You guys have too much dollar-denominated debt and it's going to create a problem. What do we do about this? We recognize the problem. They are communicating it. They are saying it right here. Lowering overall debt issuance of non-financial corporations and LGFVs could reduce dollar exposures, but only if dollar-denominated debt is reduced proportionately. This is coming from the Federal Reserve itself, trying to deal with the global demand for dollars that is going to put them in a position in which that they would send the United States into an unsustainable debt path, trying to provide the world with the liabilities to cover all this dollar-denominated debt. I don't know how many people understood what I just said, but it's a major problem. Regulations now state that the new loans are not to be used to roll over existing debt, so liquidity issues may arise before overall debt levels fall to less risky levels. A proposed nationwide property tax on homeownership may help wean local governments from land transfer fees and help reduce the impetus for LGFVs to issue debt on behalf of the local governments. However, few countries have accomplished the goal of insulating their non-financial corporations from the risk of foreign currency denominated debt. They know this. This is what's crazy about it, is they literally know it. They tell you about it, they talk about it, and then you go out onto the news and have a completely different understanding of what it is that's happening out here. If you understood this stuff, then none of their systems, none of their tactics would work. That's what I find really interesting. They literally have to create this problem that doesn't seem to really exist. Think about all the problems that people talk about when it comes to the BRICS nations, and then think about what the real problem that the Federal Reserve is facing. It's not them getting out of dollar-denominated, or it's not them. It's not our problem that they're trying to get out of dominant dollar-denominated debt. It's the Federal Reserve telling them they need to get out of dollar-denominated debt. How many people see it that way? None. Literally none. Nobody. Maybe Jeff Snyder or Brent Johnson, I don't know. Maybe they can see it that way, but I don't know. As far as I know, I don't think anybody has ever communicated this, except for the Federal Reserve through their documents to the other central bankers. However, few countries have accomplished their goal of insulating their non-financial corporations from the risk of foreign currency denominated debt, in part due to incentives to move funding activities abroad to circumvent such rules. Nonetheless, China's ability to control large portions of its economy may provide it with the tools to do so. It's incredible to think that how it is that most people look at this and understand the problems that we now face as the world reserve currency. They look at that dollar dominance and see other nations trying to remove themselves from that dollar dominance, and they think of it as a problem, because intuitively it seems like it's a problem. But then when you go and you look at the real problems that is being faced, where this dollar-denominated debt, once it comes due, starts to strengthen the dollar, meaning there's liquidity crisis that happens out there. And the Federal Reserve having to step up and provide the world with the liabilities in order to cover all that dollar-denominated debt. Think about this issue. This doesn't have anything to do with the United States. We didn't cause this to happen, right? We didn't force people to take out dollar-denominated debt. That's what I guess I should say, right? And by other nations, other corporations, non-financial institutions, whatever you want to describe it as out there, have issued out dollar-denominated debt, creating a problem for the Federal Reserve to try and figure out how it is that they are going to provide the world with the liabilities to cover dollar-denominated debt that didn't have anything to do with the United States. I know a lot of people will think, well, why don't they just let them default on it? And again, we don't understand the contagion that will take place from that, as all corporations and entities and sovereign nations and everybody else is all leveraged off of other people's debt. Meaning if they start to default, the assets that they hold is their payment. They have to make the payment for their asset to be made whole again. And if they default on it, the asset starts to lose value, and now you can no longer make your payments, and so on and so on. And this is the contagion effect that takes place. Very few people recognize it. Very few. All right. You know, I'm just going to cut it right there. I think that's enough. I mean, this document's huge. It goes on and on. How many pages is it? It's like 15 pages, so it's quite a bit. I mean, it's not something that you can't just read in an afternoon. Here we go. Let me just read the conclusion. I think we'll just cut it there. Excuse me, I choked on the water. All right. We have documented that China's potential needs for U.S. dollar funding during periods of stress are large. China's use of relatively short-term dollar funding has been increasing and seems likely to continue to grow. In March of 2020, pandemic-induced turmoil in the global dollar funding markets are, as reflected in violations of covered interest parties, afflicted a number of countries relying on large dollar rollovers. This dislocation in dollar funding for Chinese financial institutions seems to have been large, judging from the data that we have presented from the cross-currency basis for the USD, China yuan, and USD Hong Kong dollar? I'm not sure which one that one is. CNH? What is that one? Okay, during the future periods of stress in dollar funding markets, China might have difficulty in quickly sourcing a significant quantity of dollar financing and control liquidity stresses on its financial institutions and corporate sector, which could lead to global spillovers. All right. After noting some of the solutions that the Chinese authorities are attempting to implement to mitigate dollar exposure, all right, guys better do something about it. We documented some avenues for dollar funding in Chinese entities during stress periods. So while they're trying to figure out how to get out of the dollar, the United States is trying to figure out how they can fund them during those times of stresses. All right? How many people know this? None? Nobody? Among these, the FIMA repo facility, to the extent available to the PBOC, may turn out to be effective. The repo facility may turn out to be effective in terms of size and immediacy, assuming that China's FX reserves include a large quantity of U.S. government securities that are custodied by the Federal Reserve Bank of New York. The FIMA and central bank swap lines are partial substitutes for each other. Neither is likely to cover all needs, and both offer significant potential dollar funding to central banks facing a dollar funding stress event. How many people? They're trying to get out of the dollar, really, because the Federal Reserve is trying to figure out how they're going to get them dollars. Remember, this is 2002. It's not that old. In many cases, there is a risk of disruption to dollar funding markets arising from potentially large and sudden need for China's banks and corporates all to roll over dollar denominated debts. Absent in means of rapidly and efficiently dealing with these large dollar funding stresses, the adverse impacts on China's financial stability and economic growth could be substantial and could spill over to the rest of the world. See, there's the real problem. There's the real problem that nobody seems to want to talk about, and that is the dollar funding stresses in China. As people look at the BRICS nations and believe that China and Brazil and South Africa and all these other BRICS nations are trying to get out of the dollar to try and remove themselves from the dollar dominance that is out there, very few people have taken it into consideration or the understanding that all these nations have written debts that are due in dollars, meaning that they have to come up with those dollars to pay those debts back. And if they don't pay those debts back in dollars, they start to default, which is a contagion effect across the entire globe. That's the major problem. BRICS nations trying to get out of the dollar, that's not a problem. In fact, that's a benefit. That is trying to relieve the dollar funding stresses that is going to be hit across the entire globe when all of a sudden the liquidity is drying up. Nobody sees it that way. Literally nobody. Nobody understands what the real global problem is, and that is that there's literally not enough dollars to cover all the dollar denominated debt that exists. That's scary. If this debt was to all come due at once, you know how strong the dollar would get? It would strengthen to a level unlike anybody had ever possibly imagined. There is more dollar denominated debt than exists dollars to cover it. It will come due at some point. It will create dollar funding stresses, and there will be liquidity issues coming. The Federal Reserve knows this. They wrote an entire document talking about it specifically for China, not to mention all the rest of the global economies that are out there who have done something very similar to China. How many even understand that this is an issue, or even knew that it was an issue? Alrighty. Things are looking good in the villages in Florida for Boomer, Shella, and Earl. They love to fry themselves to a crisp in Florida sun. Huh. Okay. Hello, freedom lovers. I like that one. The almighty Dolred. All right, dollar's so weak right now due to the pure need of it. I know it doesn't make sense, though. I don't think the dollar is that weak. When you look at it on an index scale compared to a basket of world currencies, I mean, is it weaker than it has been recently? Yeah. But is it weak considering where we've been in the past? Not even. It's been far weaker than it is today. Lucifer, thank you so much for the $2. I'm new to the channel. Do you have any solutions for us? Lucifer, that's your problem, right? And I can't come up with a solution for your problems because your problems are unique to you. Like my problems are unique to me. So when you think about the solution, like, are you expecting me to come up with the solution for everybody's problems out there? Like, I don't think that's possible. Like, I mean, you got to go to, you're going to have to go and study a higher power to solve somebody else's problems in such massive scale like that. You can take control of your own problems and understand that there is a global issue taking place, and there's nothing you can do to reverse it or fix the problem, but you can position yourself to deal with that accordingly. So as people are looking at the BRICS nations, just think about this for just an example, right? As many people are thinking, okay, the BRICS nations are trying to get out of the dollar, that means the dollar is soon going to be worthless, and we're going to find that the hyperinflation here in the United States is going to happen within a matter of a few years as these BRICS nations dominate and kick the dollar out of the reserve currency status, and we end up failing as a nation. That is a very common thought. Do you want to think like that and take that into consideration? That the BRICS nations are going to rise and kick the dollar off of its world world reserve currency status, and we are going to be in poverty and misery on account of that. Like, this is a very common thought. Now, my understanding of it is far different. I look at it and say, no, I don't think the Federal Reserve could print at a pace that is fast enough to cover the world's dollar-denominated debt. That's going to be a major issue. And the issue that comes from it is a strengthening dollar. So to me, like, how do you position yourself accordingly for that? Well, number one, you have to get out of the banking system altogether. Like, remove yourself from the third-party claim altogether. How do you do that? Like, you can come up with creative ideas on how it is that you remove yourself from the third-party claim. The one way that I know to definitely do it is to buy silver bullion, silver and gold. You buy silver and gold, you're out of the third-party claim. They can go to war, they can fail, they can do whatever it is that they want to do. You're not affected by it because your wealth is sitting in a tangible item in your hand, right? It's not left up to a phone call or an app or a promise from somebody else that they're going to pay you. None of that exists. You have removed yourself. Once you have removed yourself from that system, now you feel a lot more confident about being in the system, because if the system fails, it's not like you're going to fail completely. Your position is going to do quite well in a failing environment. So now that you have covered yourself for the failing environment, let's understand what it is that we need to do in the current environment that is not failing. Because if you want to think about it as a failure, then you're probably not going to make good decisions, considering that everything is going to be based off of failure. Okay? So understanding that the dollar funding stresses in China are not just unique to China, but to the entire globe who has faced this, we know that there will come a time in the future in which that the dollar funding stresses will elevate. When that happens, the dollar becomes very strong. That's buying opportunity. How do you fix the problem? You can't, but you can deal with the problem. You can buy silver to get out of the third-party claim. You can position yourself to take advantage of buying opportunities when they present themselves. You can see where it is that the problems really lie, as opposed to the narrative that is being spoken out there on where the problem really lies. Once you recognize this, you don't see it as a problem anymore. You don't see it as a problem. In fact, there is no problems. There are only solutions, and everything that you are doing is, like, for me, I feel very confident in everything I do. I'm not like stressed or worried. I mean, is there failure that could happen? Absolutely. But I feel that I position myself to deal with failure accordingly. All right? Will I be successful at that? I don't know. Time will tell. We'll see. Right? I mean, but at least for me, I don't feel worried or stressed or concerned about it, because I thought about it and thought, okay, well, if that happens, how would I deal with it? Now that I've figured that part out, I move on to what it is that's happening today, so I can position myself accordingly for it. How many people out there are believing, like literally believing, that we are going to be moving to a gold standard, a world reserve gold standard, because of the BRICS nations? I have found very prominent economists out there who are very well recognized and respected out there talking this garbage, talking absolute garbage. The BRICS nations are not going to set up a gold reserve currency. That is the lamest thing that I have ever heard in my entire life. They are not going to set that up. Could one occur? Absolutely it could. Do you know how that would occur? You have to study Gresham's law. Once you understand Gresham's law, you will recognize that bad currency chases out good. You can't introduce gold into a reserve currency status so long as you have a current reserve currency in use. You can't do it. You won't do it. Think about it in this fashion. I got this computer here for sale. You want to buy this computer off of me. You come to me, you have dollars in one hand and gold in the other. And you say, hey, bro, which one of these are you going to take? And I look at it and I say, I'll take either one, whatever one you want to give me. Are you really going to hand me that gold coin? I mean, be honest with me, right? Are you going to hand me the gold coin, or are you going to hand me the paper? You're going to hand me the paper, right? You're going to take that gold coin, you're going to put it in your pocket. That gold coin will never perform commerce because you're hoarding onto it, because the paper dollar still exists. This is called Gresham's law. Right? Once you understand Gresham's law, now you can recognize, okay, what is it that's going to occur in order for gold to become the world reserve currency status? Is the dollar has to completely fail, meaning unaccepted by anyone, anywhere, for any reason, including their dollar-denominated debt. They simply will not want it. That's Triffin's, or not Sharp, that's Thier's law. Thier's law is the exact opposite of Gresham's law, and it's not a combating law, it's a complement. It's a complement to the theory, because once the bad currency has completely failed and nobody will accept it, not even to pay back their dollar denominated debts, then the good currency can come in and start performing transactions. But until then, the good currency will just get hoarded away. So I look at all these economists, all these ideas that the BRICS nation is going to set up a gold standard and all this other stuff is lame information. Does not work, not going to happen. Those people need to go back to school and study Gresham's law and Thier's law to understand why it is that the dollar is going to continue to be the world reserve currency status so long as it's getting accepted. And when you have dollar funding stresses to the level that we do in China and many other nations around the world, the dollar dominance is going to continue. It has to, or else there's complete collapse of the entire system, which could occur. Don't get me wrong, it could. Many people are preparing for that. They actively think about it and preparing for it on a daily basis. They are never taking advantage of the situation. They are always waiting and investing for failure. Good luck with that. I took a position to deal with the failure accordingly. If I played my cards right, we'll see, time will tell. But until then, I look at the reality of the situation, and the dollar dominance is going to continue going into the future. It has to, because there's no other choice but to pay back those dollar-denominated debts in dollars. And if you don't, the world collapses because of the contagion. And that's all there is to that. All right. They won't allow you to have gold currency because they cannot debase that easily. They used to, but it's much more difficult. Deplorable, they can't stop you from doing anything you want. I've done transactions in silver and gold. I've done transactions in Bitcoin, and there was nobody who stepped up to say, I don't know if this is allowed or not. It's a transaction between two private parties, and there's literally nothing that can stop it. Now, if you're talking about on a governmental aspect where you basically have to pay taxes in gold, that won't occur. It won't occur. Because of the exact reasons that you say. They will be very limited, and they don't want to give up that power. Right? And not to mention, you just can't do it anyway because the United States would fall into pain and misery, and nobody would consciously make that choice. All right. Gunner, $4.99. Thank you so much. This is for a cold beverage. It's hot up here in the Pacific Northwest. Good message today, bro. Stay fresh. Thank you so much, Gunner. I really appreciate that $4.99. You guys are awesome. Doesn't UE can economic essay for off to read UE and Brody? Joseph, I'm not quite understanding. I'm thinking maybe if you're asking if we can read the essay out loud, maybe. All right, hit the like buttons, guys. Thank you, Dishes. And everybody go check out Dishes every day. ASMR channel, doing the dishes and vacuuming and building it up. Well over, 600 subscribers, 650 now. So still a growing channel. All right, Cantillon essay, you always quote, UE didn't have link to read it, PDF link. Oh, I see what you're saying. I'm sorry, I don't have the link right off available for you. Cantillon it's spelled C-A-N-T, how does it, L-L-O-N? Hold on one second. If you go, actually, here you go, Joseph. If you go down in the description, there's an Amazon affiliate link to the essay. Just click on that Amazon affiliate link to find out how to spell Cantillon essay. Then type that into the Google search, and then the Mises Institute, M-I-S-E-S, the Mises Institute will come up, and you can get the PDF for free from that website. So just go down to the link click on the Amazon affiliate link. If you buy the essay from Amazon, I will get a little commission off of it. And then, in fact, anything you put in the cart after clicking on that link for the next 24 hours and you purchase within the next 30 days, I will also get a commission on all those items. So go buy whatever you want off of Amazon. Just click on that affiliate link first for me, and you can support the Uneducated Economist just by buying the things you normally would off of Amazon. But again, you don't have to buy the essay off of Amazon. You can get it for free at the Mises Institute. And I encourage everybody to go get that PDF, download it, and read through all the chapters, especially Part 2, Chapters 6, 7, and 8. The increase and decrease of money to the state and the further reflections upon that topic. So good. Oh gosh, the best 3 chapters in the entire book are those, right? That's what I want to read. It helps me learn that stuff. Yeah. Alrighty. Thank you, Brody, for helping Joseph out there. Will, thank you so much for the $5. This is one of your better non-member videos, Simon. Just sharing some appreciation. Yeah, you bet, Will. I appreciate you too for commenting that. I was considering making this a members-only live stream, but I've already done this entire document in a members-only live stream. So if you want to go back and watch that, it's $1 a month to become a member of the YouTube channel. Once you have become a member of the YouTube channel, you'll have access to many member-only videos where we have broken down the speeches and including stuff like this dollar funding stresses. This is how we are understanding what it is that's taken place with the monetary policy, because once we have a better understanding of where the monetary policy is going from the Federal Reserve's perspective, not from, some lunatic, YouTuber out there just trying to claim that they understand what's going on with monetary policy and just, basically giving out a bunch of diarrhea of the mouth. This is coming directly from them. Right now, of course, I'm reading it and giving my opinion, but I'm sharing the links with you for you to go and read for yourself so you can internalize that information for yourself and form your own opinion. That's the point of this whole channel. That's the point of me even putting the links down in the description, is so that you can go and learn this stuff for yourself the way that I have done it, because the way you internalize it is going to be different from the way that I internalize it. When I share the message, I am sharing it with an opinion. It's coming with my ideas of what this means to me. Now, it may mean something different to you, and that's why the importance of going and looking at the link is there. That's why it's so important for you to go and do it. But again, being part of the conversation while we're going through and reading through these speeches and these documents, it's incredibly helpful. Like, I've had so many people come to me and say, dude, man, since I started following your channel, I have such a better understanding of the economy and my position within it, and to understand the underlying economic forces that are creating what a lot of people are blaming are actually symptoms. Right? And once you recognize the symptoms and you hear people talk about it, you're like, oh man, they're talking about Gresham's law, they're talking about Griffin's dilemma, they're talking about the bullwhip effect, they're talking about Cantillon's, the Cantillon effect. You start recognizing these underlying economic forces that were really, talked about hundreds of years ago, right? And it's kind of hard to to see them in the same fashion, because when they were described hundreds of years ago, they were talking about horses and wagons and stuff like that, and today we got airplanes and cell phones. So it's a much different type of economy that we're working in, but the underlying economic forces are still there. Do you ever read the big, beautiful bill and what's in it? Nope. I'm sorry, I don't. Because most of that, just like all the tariffs, like if you took in prior to today's date, but like went back, 2-3 months ago, even 4 months ago, trying to understand where the tariffs are going to mean for the economy. How many people say, how are these tariffs going to impact the economy? What's this really going to mean? And I kept saying it over and over again. What tariffs? Which ones are we talking about? Are we talking about the ones that are being discussed and negotiated and have workarounds and exemptions and changes that are constantly happening to it? To find that Trump came out again, August 1st, guaranteed, no exceptions. And I'm like, again? again, like you're just gonna rehash this same thing over and over and over again when nobody is really even paying attention to it anymore. I mean, is anybody really threatened by the tariffs anymore? I mean, they tried to make it that way, but now I have people who come in who are asking, oh, what is the tariffs going to do to the lumber industry? What's the tariffs going to do? What's the tariffs going to do? I haven't heard a peep out of anybody lately. They just don't care. They're like, I don't know, like I don't know. They're like tariff fatigued. I guess that's a good way to put it. What time is it? Ah, shit, I gotta go. Uneducated Economist. You guys let me know.